Joining us on the India development debate this evening is a power-packed panel. Mr. N.K. Singh, chair of the FRBM panel, Mr. Shaktikanta Das, former Economic Affairs Secretary, Mr. Pranab Sen, former Chief Statistician of India, and Ms. Kiran Mazumdar-Shaw, Chairperson and MD of Biocon Limited. Thank you so much, each one of you, for sparing the time and joining us here at ET Now. Mr. Singh, I'm going to start off with you. The euphoria is understandable in markets and, in general, in the economy as a whole, because this ratings upgrade has been long overdue and has come after a span of 14 years. But yet we are now just 2 notches above the junk grade. So we must not lose sight of where we are. How big a deal, according to you, is this ratings upgrade, Mr. Singh?
Well, I think that this is a very significant breakthrough in terms of the outcome or the kind of economic strategy which has been pursued by the present government. It is really very significant considering that it comes after 14 years. And isn't it in some ways quite ironic that 14 years ago or 13 years ago, it was also an NDA government, and now the upgrade has taken place. There's a clear recognition of and an endorsement of the India's economic strategy. If you read the detailed report of the rating agency, you will find that all the important ingredients of the economic reforms which have been recently undertaken, like the GST, like even demonetization, like the Aadhaar platform, like the increased reach of the digital, like cleaning up the balance sheet of the banks, like the bank recapitalization program, and of course, a compliance to overall macroeconomic stability, the observance of fiscal norms, and an independent monetary policy committee. All these have been very specifically mentioned in the report. Right. And the report clearly goes on to say that one of the key factors which has led to this rating upgrade is that countries which are placed in similar position have a better rating than what we had, and that there are few countries which can match India's unrealized growth potential, and that they believe that the continuation and deepening of this economic reform process will really lead India into a new economic bracket. They project continued higher economic growth in the years to come. They foresee a continuation and deepening of the reform process. They see a continuation of policies which will minimize risks from their point of view as a credit rating agency and enhance productivity and growth, creating a virtuous circle.
Okay, you've put it in a nutshell what all of this will do and the rationale for that. But Shaktikanta Das, you've often made a pitch before the ratings agency, so I think some kind of congratulations do come your way, because till just about a few months back, as Secretary, Department of Economic Affairs, you were making pitches like these to ratings agencies. So yes, I mean, there is some validation in terms of what the government has done. I really want to understand from the point of view, what does this do to capital inflows and the cost of debt? If you can put it in perspective for our viewers here.
Before I reply to your question in specific terms, let me say that I feel this rating should have come about a year ago at least. And from the government, from Department of Economic Affairs, we had been repeatedly pointing out to institutions like Moody's that they are probably far detached from the ground realities. And it has been always their contention that reforms in India should be sustainable, they should take deep roots. And we had been of the view that reforms are sustainable, and that is the quality of reforms and the number of reforms are not only sustainable, but they were taking deep roots. And I am happy that even if it's about a year late or so, finally Moody's have recognized. Of course, they have their own way of looking at it, so it's fair enough. But specifically to reply to your question, you see, even without a credit rating upgrade, India has been attracting a lot of investments. Last year, we were the largest recipient of FDI, even higher than China for the first time. And the FII inflow has been fairly steady. Now, what it will mean is that this credit rating upgrade, which I would expect other credit rating agencies also to sort of adopt similar approach. Now, this credit rating upgrade would definitely be a this will definitely enthuse the other investors and to sort of bring in more money into India. And the cost of borrowing, naturally, when the rating improves, the cost of borrowing so far as private corporates are concerned, although it is for government bonds, even for private corporates when they go for ECB borrowings, etc., for them as well as the investments for in government GSEC segment, I would expect the borrowing costs to come down. And in the background of the government's announcement of going for some bonds for for some borrowing some bonds for recapitalization of banks, I think in that segment also it will have a positive impact in terms of reducing the cost of borrowing and in terms of limiting the interest payment outgo per year.
Sure. So you're saying it will bring down cost of borrowing significantly. Dr. Pranab Sen, in terms of how big a deal this is, and obviously markets have rejoiced this upgrade because it was long overdue. But from a slightly more medium-term view, is there a direct link, between ratings and asset performance? Look at China, for example, which was downgraded by Moody's in May, and we've seen the equity market move up some 26% in dollar terms. So does this necessarily imply that we will see more capital flows come in, especially in the debt segment of the market? What's your own sense on the link between, asset performance and a ratings upgrade?
Not very strong, I'm afraid, not at this level at least. The fact of the matter is that these ratings make a difference to the smaller portfolio investors. The big ones don't actually care very much about them, they do their own research. And, as was, I think you mentioned, that this is only 2 notches above junk grade, it's still not going to enthuse small investors to come rushing into India. You'll need at least 2 or 3 more upgrades before that starts happening. But that's nothing to shed tears about. The more important issue is what it does to FDI. And frankly, I think the combination of the ease of doing business rating and this may actually persuade companies to look at India, not necessarily come here, but in terms of which are the countries they would look as potential options for investment, India would go up a little bit.
All right, Kiran, if I may come to you, and this has to be also this has to translate in some sense into private investment. I mean, that's one of the things that policymakers at least are alluding to, because the cost of capital will come down, and of course it's a sentiment booster. While yes, FDI is one part of it, will this lead into substantial private investment taking off as well?
So first and foremost, I want to comment by saying that this upgrade in our credit rating by Moody's is actually a reflection of the economic reforms process being aligned with the economic potential of India, and that's a very positive signal, because it basically means that people are taking notice of the fact that we are putting into place policies and reforms that are going to align with the economic potential, which obviously triggers growth. I think people for long have realized that India is a great economic growth potential, but somehow the policies and the reforms haven't quite aligned with this potential, and that's the first thing I want to comment on. The second thing I want to say is, certainly with this kind of upgrading, I think there will be stronger investor confidence, which we are seeing of course in the stock markets, but also in the investment climate. I think lower borrowing rates will also trigger a much bigger interest in investments. And considering the fact that the government is also embarking on large infra investment projects, I think this augurs very well to see greater investor confidence in India.
Mr. Das, come in on that, because the government for long has been trying to move the needle on private investment and hasn't been able to do it. 3.5 years into office, we still don't know when is a private investment cycle going to kickstart. Do you believe this could be an altering moment for that? Could this be the trigger needed to kickstart the private investment cycle, or do you think more reforms need to be undertaken by the government before corporate India gets into investment mode? Because again, there is a concern on excess capacity in the system as well. But will this move the needle on private investment?
You see, the investment through bank credit, that probably has not taken off. Now FDI, I mentioned little while earlier that FDI, we have, our numbers are definitely have been very good, and they will continue to be good. There is a lot of investment coming through the, through the corporate bond segment, through the ECB segment, through the private equity segment. There is a lot of investment happening through those routes. Now the problem in the banking sector are various, and one of the major problems has been tackled by the government recently, when the finance minister has announced the recapitalization of the public sector banks, and together with the assurance on governance reforms with regard to public sector banks, as and when government spells out the governance reform measures and the other reform measures relating to the banks, I think that will be a huge positive. What this credit rating upgrade does is that it gives that much more additional confidence to the foreign investors, and together with the kind of impact that all the reforms in India which have been taken over the last 3.5 years, together with the impact of all the reforms which have taken place, together with the improved ranking of India in the ease of doing business, and the other, the other positives on the fiscal and other fronts, and with the resolution of most of the GST related issues which arose in recent months, I think the overall signal to the private sector is that this is perhaps their time to invest, and I would see this as a positive movement towards a revival of private sector investment in India, whatever that may mean, through, that is, in other words, through the bank credit route. And of course, a lot of private corporates have their own they have their own leveraging capacity, and I think this is a positive signal for for injecting that much of extra push to private sector investment.
No, absolutely, and we'd keep our fingers crossed for the private sector investment to take off, because that engine of growth has to fire for meaningful growth to pick up. But I think Mr. N.K. Singh, one of the things that this report very categorically speaks about is reasons for the upgrade, reasons that will lead to a further upgrade, and then reasons that could lead to a downgrade. And one such reason, in fact two such reasons, are fiscal consolidation, the health of the fiscal space, and the health of public sector banks. But I will ask you, on fiscal consolidation, do you believe this report and this upgrade puts more onus, puts more responsibility on the government to stay the course of fiscal consolidation? Because a lot of people have spoken about a fiscal stimulus, people have spoken about how the government needs to spend more. Is there perhaps more, is it going to be more challenging and perhaps a greater, pressure on the government to stay the course of fiscal consolidation?
Well, I don't think that the credit rating is entirely predicated only on the fiscal consolidation path. It does mention the fiscal and the congruence of monetary and fiscal policy as an important ingredient in the methodology which they have employed and the outcomes which they have reached. And really speaking, if you ask me, few other governments in the past, I remember, in the course of their tenure, have shown such resolute determination to pursue the path of fiscal consolidation as the present government, and the finance minister's successive budget underscores the importance of which this government attaches to continued macroeconomic stability as an important framework for overall economic policy. Yes, I agree with you that there is more than implicit recognition in the report that this government is committed to continuing fiscal consolidation. It recognizes that the fact that the government is committed to pursuing this, the downside risk of debt increasing very sharply has been more or less, I mean, it does say that the debt will increase by 1 percentage point this year and may increase in the short run. But it sees that the virtuous circle between enhanced revenue, enhanced nominal GDP growth in the medium term, and concludes the fact that the debt will remain on a downward trajectory, and the direction of the debt in the medium term has influenced Moody's in a very significant way to come to this conclusion. I agree with you that commitment to continued fiscal consolidation, which is watched carefully not only by Moody, by markets, but by other rating agencies, and generally for an overall climate contributing to macroeconomic stability.
Ask this one on first.
Dr. Sen, comment on that, because S&P, for example, has said that, for them to move, they'd like to see the government, act more decisively on the fisc. Does this, in a sense, put more pressure on the government to meet its 3.2% deficit target for this financial year and ensure it stays the path on consolidation? Because there's been pressure from various quarters of the government as well. The Vice Chairman of Niti Aayog, for example, has been making a strong case for the government to ease its fiscal deficit targets. So do you think that this is going to put more pressure on the government to ensure it sticks to its fiscal discipline?
Well, it is going to put pressure, and that's the whole idea, right? I mean, the fact of the matter is that the rating agencies are essentially trying to influence the course of decision making in government. And that's something I think we need to be very conscious of. At the end of the day, it is the call of the elected government on what they should be doing on the fiscal policy side. Fiscal policies have to be context driven. They cannot be driven by essentially what external agencies think that you should be doing. At the end of the day, the government is answerable to the people.
Fair point indeed. Ms. Shaw, I'm going to take forward the question about demonetization and GST. I mean, both issues largely economic but hugely politicized. Given the fact that this ratings upgrade talks about formalization of economy that happened due to demonetization, in some sense, do you believe that actually ends the debate on demonetization? Is this all that we're going to hear on demonetization? Because, the politics of demonetization can be debated ad nauseum, but the reality is that a ratings agency believes demonetization did the Indian economy good because it paved the way for formalization.
So I would go with that, rating agencies' perspective. But more importantly, I think what has really, bodes very well for India is the GST. I think GST is a major economic reform which is going to move the needle. And I think, the recent measures that have taken place to rationalize some of the GST slabs, I think will really see a much more positive, impact on investor confidence in investment. In fact, one of the things maybe they should look at when it comes to infra projects is to see whether they can actually move the cement from the 28% GST into a lower slab. I think we really need to create what Mr. Singh talked about, the virtuous cycle of investment and returns. And I think that is what will, drive private sector to invest in many of these economic opportunities that we so badly need to address.
Fair point. Mr. Das, I will take the point about formalization of economy a little forward, because if you actually see the money that has flown into mutual funds after demonetization, when people were forced to park their money in banks, or the money that has flown into insurance premia, or for that matter, the money that has flown into capital markets, there's been a huge sums of money, and that is what is financialization and formalization of the Indian economy, but largely driven by demonetization. My question really is, can the government, and what should the government be doing to sustain this trend? Because, the fear is that Indians will go back to investing in gold or real estate all over again. The money came back to the system as a forced measure, and which is how it found way into financial instruments that we greatly support here at ET Now. But how does the government sustain this process?
See, one of the positive outcomes of demonetization and now GST has been is that I think there is a greater premium now placed on digital transactions, and people across various segments, they sort of they recognize the importance of digital transactions, and the fact that money has gone into bank accounts and creates a tendency of money remaining there. I have been sort of interacting with people from various segments of society, and also I have been watching various other television interviews with people, you know, across especially at the bottom of the pyramid. And generally the sense one gets is that earlier bank accounts which had very minuscule account balance, today the effort is to keep, you know, like when the money comes into the account, only that much which is required to be spent, that gets drawn and spent in cash, perhaps at the lower segment. So therefore there is a greater push towards formalization, there is a greater push toward digitization, and with regard to things like gold, etc., I think the the gold bond scheme also has been made that much more attractive. And overall, with a mindset change and with GST coming in, I think we have now moved to a formal, the formal part of our economy has become stronger. And so far as the government is concerned, I think if I can deviate a little bit, I was hearing your earlier question. I think this year the fiscal deficit, it all depends on the GST revenues. If the GST revenues are marginal, I am sure that can be made up by by the government. There is always a plan B which will take care of that. Disinvestments are doing very well. So far as next year is concerned, I think a 3.2% fiscal deficit target, which has been mentioned by the finance minister in current year budget speech, I think seems to be very achievable. But coming back to your original point, I think the formalization of the economy has received a big push, and that I think augurs very well for our economy, because that also widens the tax base, which helps the fiscal situation.
Mr. Singh, let's sort of look ahead and Moody's builds a case for what India needs to do to get an upgrade from here on, and there is a lot of headroom for us to move forward up that ladder, that steep ladder, and it specifically speaks of land and labor reforms. As someone who understands polity, you work closely with state governments as well. This needs, of course, a lot of support of state governments as well. Given the political capital that that the Prime Minister enjoys, do you believe that this government now needs to put its focus on land and labor reforms, politically contentious issues, but critical issues from the point of view of industry at large?
Well, I think that the path forward has also been laid out in the Moody's report in some form or the other. It does talk about the unfinished agenda. I think the path forward consists of 3 or 4 ingredients. One, a continuation of the reform process in the path of fiscal consolidation and the lowering and declining path of debt to GDP in the medium term. 2, to address the issues of other factors of production like land and labor, which you have mentioned. These are really in the domain of the state government, and that, unlike the previous government, this present government is quite committed to approving all labor and other regulations which have been approved by the state governments, and a bit of nudge economics, a bit of incentives, and a bit of endorsement. So I think nudging and incentives with state governments should work better in really taking this unfinished part of the economic reforms forward. And I think that if it does that, I think there are clearly marks waiting, and clearly I think that will set the stage for a further credit upgrade. I agree with Pranab Sen that we shouldn't stop here, that we need to look to further upgrades of on our rating to really get another big burst of foreign investment from this time large corporates, and not only small and medium corporates who may have an information asymmetry in terms of prevaricating on their decision of whether to invest or not. So I agree that some of the unfinished agenda of economic reforms, particularly as it leads to state governments, have also been articulated in this report, and that I think is a path forward.
Ms. Shaw, how are you going to join this debate? I mean, you know, this whole debate about things going forward and things that we must look forward to in terms of a further ratings upgrade. And you know, Moody's in its report has very categorically stated there are decisions that haven't gone to fruition, but they're taking those into account, whether it's land or labor reforms. Given the political capital that the Prime Minister enjoys, and we've all seen that Pew survey that has come in, and he seems very high on popularity, you know, how would you expect this government to use that political capital to push the two things through? Because they are both very, very politically sensitive issues. Do you expect them to bite the bullet on those?
I think Mr. Singh has put it extremely eloquently. You need nudge economics. I think you need to nudge and incentivize states to adopt these economic reforms when it comes to land and labor. And I think that's the only way the government can actually push this reform process forward. So I think, you know, everyone has made some very important comments, and all that we can agree on is that we have to keep the reforms process going. And I think everyone has a fair understanding of what it's going to take to get this further upgrade. And I think we just have to remain very focused on this course of reforms.
Dr. Sen, the other risk factor that could lead to a downgrade on the flip side, it's important to mention that one is of course fiscal discipline, and probably Mr. Singh is right, the government will stay the course there, but is the state of banks. And it's good to see ratings agencies acknowledge the government's move towards recapitalization of banks, and of course this recap bonds as a mechanism despite its short-term implication on the fisc. But it does raise concern on the health of the banking sector at large. Could that be, is that an area that the government needs to do more on? What more do you think the government can do to ensure that the state of banks remains under control? Dr. Sen.
You know, I think we need to be very careful when we put all the blame on the banks. If you actually look at the history of the problem, much of it actually derives from the government actually arm twisting the banks into making loans for the infrastructure projects. The banks were not comfortable with it for the longest time. It's not what they were designed to do. And the net result, of course, is that they ended up putting money in areas that they were unfamiliar with. The question is that if you divert attention from the type of lending you do to the governance issues of the bank, you may actually be missing the problem and repeat the same mistake over and over again. The main question is that if you are asking the banks to invest in long-term projects, are you sure that the banks have the technical wherewithal with them to be able to handle such lending? And my sense is that most of the Indian banks are not. They were not designed for that purpose, and they were forced to do it kicking and screaming.
Mr. Das, you spoke earlier about the fact that this is long overdue and that you felt it should have happened a year ago. And again, with this upgrade, we're at par with Spain and Portugal, countries with a significantly worse situation on the debt side, and of course, nowhere close to the growth outlook that India has. Do you believe this will now put pressure on S&P and Fitch and all other rating agencies to look at an upgrade almost immediately?
Well, immediately or in the near future, I cannot say, but let us recognize that each rating agency has its own way of looking at things. But then the facts and circumstances of the case, or the objective facts around the India story, is the same for all rating agencies. So now one agency, the Moody's, having done it, I think it will have some kind of a demonstration effect, and will have some kind of a nudge effect, if I can use that word, on the other credit rating agencies also, because each credit rating agency, I mean, I have been taking this position all along, they need to realize the ground realities, and the ground reality of India is that reforms which have been undertaken are qualitatively, they are very robust, they have taken strong roots, and they are sustained, and they are sustainable even in the future. So I would expect the other credit rating agencies also to follow suit.
You expect other credit rating agencies to also follow suit. But Ms. Shaw, you know, I will ask you a little bit of a controversial question there, and I think while we laud the government on the ratings upgrade, and perhaps it's come deservingly so, I think we also have to be skeptical on the issues on the ground. Do these ratings and an upgrade there reflect the macroeconomic realities of the ground? I mean, CAD is under pressure, growth is not picking up, there are no jobs, private sector investment isn't breaking ground in a big way. You know, so I really think I'm going to ask you as an important voice from the Indian industry, is this perhaps a reflection at all of realities on the ground?
Well, all I would say is that there are some positive green shoots and signals to incentivize investment. And I know as a company, we are certainly investing in growth, in expansion. And I think you need to see these positive signals coming from credit agencies, borrowing, the larger fiscal and macroeconomics. And I just hope that, you know, with better rationalization of all the GST rates, I hope that can also see some incentives coming into private investment. But one very important thing is we have to remain committed to the reforms process, and we must make sure that the states are also aligned with the reforms process and make sure that wherever we need to tweak it, we must do it, because without effectively implementing reforms, again, you're going to remain short of the opportunity. So I, for one, feel very confident that with all these positive signals and sentiments, I think it should augur well for investment.
It should augur well for investment. Mr. N.K. Singh, I'll let you have the last word. You know, you spoke earlier about the fact that the last upgrade happened under the leadership of Atal Bihari Vajpayee when the NDA government was in power. It's taken a long time since then, but some would argue that, you know, even after that ratings upgrade, the government couldn't retain power in 2004 because it probably wasn't reflective of the mood on the ground. Is this a similar situation, or do you fundamentally disagree with the fact that this situation is different from what it was back in 2003?
Well, I think that this question was posed to the finance minister, and in fact in the press interview a few hours ago, and he did say that electoral politics is quite different than a credit upgrade, and that moving away from populist policy has been one of the fundamental driving force of this government. I must say the government, in some ways, having worked earlier in the earlier NDA government as Secretary to Prime Minister Vajpayee, I would say that he also had an abiding commitment to fiscal consolidation. And that how is it that the two NDA governments which we know are the two governments which have been aligned as far as macroeconomic stability is concerned. But I also believe that the present Prime Minister's vision, when he talks about 2022 and beyond that, goes beyond the narrow confines of populist electoral policies. And that is why I think that rating agencies like Moody are sanguine that India is committed to the path of not only economic growth, pursuit of policies which would be gainful in terms of enhancing productivity of the economy, will incentivize private investment and create the virtuous circles. I think that you raised the point about the participation of the states. The Prime Minister has repeatedly mentioned about Team India, and in Team India he has mentioned about the fiscal compact. In fact, the GST is a classic example, and the functioning of the GST Council is a classic example of the extent to which you can draw the states in terms of accepting decisions by consensus without voting on matters which would be good for the overall growth of the Indian economy.
Indeed. On that note, completely out of time on this very, very special show. Thank you very much, Dr. Pranab Sen, Mr. N.K. Singh, Mr. Shaktikanta Das, and Ms. Kiran Majumdar. Can't thank you enough for joining us on a day as big as this, India's first ratings upgrade in 14 years.
We'll step into a short break. On the other side, the political debate as a fallout of this ratings upgrade. Back in a moment with representatives from BJP, Congress, the BJD and the Samajwadi Party for a fiery political debate right here on ET Now. Keep it with the India Development Debate.